Having dealt with many of these banks since before some of your viewers were born, the issue is that a lot of their systems were implemented before your viewers were born. And so what we're seeing is the profits being made from rising interest rates, particularly on loans, credit, but at the same time, huge challenges about how to restructure these companies to be digital, and also recognizing the huge competition that's risen from the fintech marketplace. I saw a fantastic figure from 2021 analysis that showed that the fintech community, which is these new technology unicorns and startups, now represent almost 40% of the valuation of total financial markets capitalization compared to the banks, when they were just 3% in 2010. So we're seeing a massively changing marketplace. And as a result of that, the valuations of banks are going down, and their price to book ratio, as you mentioned, is the worst of all industries.
Chris, there's a lot in there as well, not least the fact that I know you're not talking about me when you're saying before I was born, because I'm the same vintage as you. But I'll park that one. But in terms of these fintech companies and these technology companies coming up to be a larger part of the market, it's very important to drill down on this, because as far as I can see, the major banks still have a dominant position in the customer-facing activity in many jurisdictions. Are we talking about what's under the hood in the financial sector, what's actually going on with the payment systems, for instance?
Well, there's a huge number of things, and every part of banking is being focused upon by specialists that can do banking better. And I was just looking at some numbers this morning. So, there's over 200 unicorns that are new companies since 2000 worth over $1 billion that are drilling down into changing banking. Stripe is one of the ones that we know really well because they're payments, but it's in every aspect, from wealth management, private banking, through to consumer banking, commercial loans. Every aspect has a specialist company that can do this better, particularly with technology and making it simpler and easier. And that's where I specialize, in that specific space. So I think the challenge for most financial institutions is that the executive leadership is firmly embedded in traditional financial structures. They don't understand these technology systems as well as others. Open banking has made it completely open through regulators to attack. And there's a report from McKinsey just the other day showing that most banks are losing 1 or 2% of their value rates every year because of this.
Chris, to what extent is the fintech challenge also now starting to erode the margin story? Because this is a feature we're just talking about, the fact you're going into a cycle where still rates have not been cut by central banks, yet the NIMS erosion story has begun. Just walk us through the competition here and how various jurisdictions are playing out from the United States to Europe at this stage.
Well, it's interesting looking at the HSBC results. I mean, they handled 26 IPOs during the last year, I think, and they've only actually generated $7.7 billion through those IPOs, but zero increase in their debt and underwriting fees. And this is because it's easier to estimate loans through software servers and algorithms than it is through people and buildings and humans. And this is the point I regularly come back to, which is that if you have a specialist company that can do underwriting through an algorithm, then obviously you're going to be far more effective than any organization that still depends on moving paper around the company or emails around the company. It just doesn't work like that way anymore. And unfortunately, an awful lot of the traditional financial institutions haven't got the setup to deal with this in the same way that a specialist startup has. And that's the reason why the specialist startups have so much opportunity, and there's over 200 unicorns out there doing this.